Hey everybody, it's Chris with Life 180 and thanks for being here. This is my first video being back from Costa Rica. Actually, it's my second video. I just did a video a couple minutes ago and I realized into the stream that the audio was jacked up and it wasn't working. So for anybody who showed up to that ahead of time, I apologize. My bad, total rookie mistake coming back from Costa Rica after not working for 2.5 weeks and hopping right back into the studio and trying to make things happen. And total fail on my part, so I apologize if you watch that. But I think this video is going to be really good. I'm really excited about it just because of the fact that I get this question a lot, talking about how to amplify the returns in your policy. If you understand kind of how I feel about life insurance as an asset, you understand that I don't look at life insurance as an investment. I look at life insurance as an asset. I look at it as a savings vehicle, not an investment. And the reason I look at it like that is because there's no risk in whole life. The only risk to your whole life policy accomplishing what you want it to do is you not paying your premium. When it comes to index universal life, that's not the case. So I'm talking strictly about whole life insurance, and I actually I'll talk about that a little bit more as we go through this video. I think it's going to be really important actually because it kind of solidifies some of the comments and perspectives that I've had as we've gone through here. But when I talk about amplifying the returns in your policy, I'm not talking about policy design, I'm not talking about structure, I'm not talking about how to fund it or anything of that nature. I'm not even talking about the and asset component of everything that you can do with a whole life policy, like how to use real estate to get good returns, or fixing and flipping, or hard money lending, or anything of that nature. That's not what I'm talking about. What I'm talking about is actually how to leverage the loan provision. And one of the, I don't want to say negatives, but if you understand how policy loans with whole life insurance works, you understand that the cost of the loan shifts based on the fixed market, right? So if dividend rates go up, your cost to borrow is going to go up. If dividend rates comes down, your cost to borrow is going to go down. So your loan rate is always going to be pretty much tied in correlation with the dividend rate of the policy. The loan rate is always going to be a little bit higher than the policy dividend rate, and that's just the way it is. So for instance, if your dividend rate is 5, then your loan rate is probably going to be 5.5. That's just something to consider and something to understand as you look at this. One of the things that I'm going to talk to you about today is something that's really, really powerful. Now, I do want to say that when you talk about the loan, borrowing against your policy, one of the important things to understand is actually, let me see if I can pull up my whiteboard here. I'm going to see if I can do this. So one of the things to understand here, and I'll share my screen as soon as it loads up. Okay, let's see here. Got it. Okay, so one of the things to understand when it comes to your loan rate and the concept of amortized loans and compounding interest is, like, if I had $10,000, right, and I took a loan, and then I had an account with $10,000 in it, right, and let's say I paid 5% and I earned 5%. Well, this loan rate is going to go down because it's an amortized loan. So year one, I'm going to pay $500 on it, right? So actually, I'm gonna do that. I'm gonna pay $500 on it, so that's going to be a $500 loan expense, right? And if I pay that simple interest, then I still owe $10,000, and I'm earning that money, right? I'm earning. I'm just gonna basically be back to where I belong. I could pay the interest only, I could let it compound, I could do whatever. But here's the cool part. All the while with a whole life policy, if you borrow against it, you're gonna have compounding interest. So you earn 500, so that leaves you with 10,500 after year one. Then you earn the 5% on the 10,500. Meanwhile, if you paid the 5% interest, you'd be only having the 10,000, you'd be earning that, the difference. You're compounding as time goes on, and over a long period of time, it adds up to be a lot of money. Now, the difference is, we could not pay this and we could just have $10,500, and it'll be a wash. Now, if, for instance, in real life, the account is earning 5% and you're paying 5.5%, I could still show you in a way that people who use this to buy negatively performing assets, you're still always going to want to, you're always going to want to pay that off. You're always going to want to make sure that when you buy anything, you have a structured strategy to make that payment, to pay that asset off, right? You have to do that. And so you're always going to be paying down that, even if it's a house, you're going to be wanting to pay it off, pay it down like you would a mortgage, right? So I could show you the math. I'm not going to get into that. That's not the purpose of this video. I could show you the math that if you're paying 5.5% and earning 5%, the declining amortization in a 5.5% and the positive compounding of a 5%, you're going to come out ahead by doing it that way. I could show you how that works. I could do more videos on that. Let me know in the comments if you want to see those. That's something I'll get into. But here's the great part. When you take a loan with a whole life policy, I know this is a little one-on-one for some people, but it's important to understand that when you take a loan from a whole life policy, you have unstructured terms, meaning you don't have to pay it back. If you decide that you don't want to pay that $500 interest through the year, you don't have to. You can let it ride. It's great sometimes for using it as your own kind of reserve account for a business account to cover payroll for businesses that are busy seasonally, and then they have big influxes of cash and then big dead times where they have no cash flow at all. They got to tap into reserves. They can refill the coffers and reserves once the cash comes in, and they can cycle through and handle it that way. Whole life policies are great like that because there's the loans are completely unstructured, completely guaranteed by the cash value, and if you don't want to pay them back, you don't have to. That can get down another conversation. We're not going to go there. Those are the benefits. I'll leave it at that. The negatives to it is that the interest rate's a little higher. So depending on the situation, depending on your circumstances, depending on your needs and how you plan to execute and implement, one of the things that is cool to look up is this concept, and I'm going to go here and I'm going to share my screen again. Let's go here. All right. It's the concept of what's called a cash value line of credit with life insurance, right? So I intentionally haven't gone through and looked at all these companies. You can see there's a couple I've clicked on and highlighted. I've searched a couple different ways to find different companies. You can find this company, Ameris Bank, cash value life insurance line of credit. You can ultimately utilize your life insurance cash value to get a 3-year term, renewable, no prepayment penalty. Typically what I'm finding with these is about 3% interest line of credit, which is amazing on the cash value. So mind you, if your loan rate with a life insurance company would be 5.5, you could take that same cash value, you can get a credit line for up to 95% of the current cash value in your policy. They say collective cash value because if you have multiple policies, which a lot of people that utilize this strategy of an and asset have stacked their policies. They have 2 or 3 or 4 or even sometimes 20 policies, because you should never design a policy to try to put a lot of money into it later. Always optimize and maximize for the cash value that you can put in today and that you're comfortable with today. And if you want to do more later, do that. The credit line up to 95% of the current collective cash value, and you get the line of credit set up. Typically, there's no origination fee. That's amazing. And so it gets it going. This is just one bank, right? So a lot of people are asking, how do you do this? Well, you just go, you can set up, you can apply. The negatives to using a bank are there are going to be credit checks, so that does come into play. And when you do use these, it's a line of credit. So typically, you're going to be responsible on a monthly basis to pay the interest-only payment on whatever amount of cash you've utilized out of that line of credit. If you don't use any money, like any line of credit, there is no expense to having that line of credit. You can set it up. It's something great to have set up, to have sitting there, to have waiting for you. And it's phenomenal. You can see this other company, Coastal State Bank, cash value line of credit. Multiple policies can be assigned to one line of credit. It's good to look at all these different banks. There are different banks have different rules. This bank will do minimum line of credit of $100,000, maximum $2.5 million. They do a 60-month term. So that's actually a 5-year term. So go through, find your needs, find the right bank that works for you. You can even go to your credit union. You can go to your local bank. A lot of them, they don't advertise it or market this concept or philosophy, but they will leverage it. I mean, I know I did before, and this is before I even got into the life insurance business a decade ago. It was about 16 years ago. I wanted to buy a 4Runner. And instead of paying cash for my 4Runner, I went down to the bank because I wanted to build my credit. I went down to my bank. And that's the other good part when you have a line of credit. You do this, you can use your cash value to boost your credit. It's a great way to go. It's a lot easier to qualify for this because it's secured by an asset of cash. There's no way the bank can lose. That's the great part. So it's easier to qualify even if your credit is a little subpar. That could be a great way to help build your credit. I did this back in the day with my 4Runner without using whole life because banks are open to doing this. I went into the bank and I said, listen, I don't want to pay cash. I want to get a loan. I want to build my credit. I was 25 years old when I did this. And I said, I have $16,000. I want to buy a used 4Runner. I don't want to get a loan on it, but what can I do? And they said, you can do a cash-backed loan. I said, okay. So I put cash in like an escrow account. They held it. And they charged me 1.5%. I think it was 1.5 plus 1. It was like 2.5% interest ultimately at the end of the day back then that I had to pay, but the money was sitting in their account. There was literally guaranteed. So I was paying a small fee to boost my credit and to like get everything going. And as I made the car payment, the cash value, the collateral that I put up became liquid. I could tap into it if I wanted to, right? So all good stuff. Like this is the same concept, but utilizing the cash value in your life insurance and getting all the other ancillary benefits that go along with having a whole life policy. Now, here's the important thing. You cannot do this with an index universal life policy. You will go through these. You will see that all of these companies that do this, and I'm not going to get into it right now. I would say go to Google and type in cash value line of credit, cash value life insurance line of credit. Go through the banks. There are dozens of them out there that will do it. What I would say is you can qualify for better rates. If yes, it's going to be credit checked. Yes, it's going to be there's going to be terms and structures to how you have to how you have to make the repayment of the loans that you take. There's no fees if you don't use it. It's nice to have accessibility to. But if you're going to use your cash value to buy a house, for instance, to buy an investment property, a turnkey real estate property. I'm thinking about the ones that we do in Atlanta. This is a great way to do it rather than say, I'm going to use a loan against my policy and pay 5.5% to the insurance company. Why not use a loan against your policy, get a line of credit, pay it back to the bank and use the cash flow from the rent that you have to pay back at a lower interest rate. You're going to be paying it back anyway, so that's no problem, right? And so all the while that can, give you more leverage and since you're going to be making structured payments anyway, you might as well be doing something and paying a lower interest rate while you can. If you're doing that, I would make sure you look for a bank that gives you a longer term on everything, because that could be super powerful to have a line of credit open for longer. That could be a really good thing. So the other thing I was going to say is, and what I started to talk about is the fact that for index universal life, you cannot use cash value lines of credit for universal life. And, I always talk about the fact that IULs are not all they're cracked up to be, all that they're sold as. I don't have a problem with IULs as a whole. I had this conversation with a person the other day. IULs are not bad for the right person, but they're the most missold product that exists on the face of the earth. The downside protection, upside potential conversation is one of the most overplayed conversations ever. If you think you're smarter than a bank, you got another thing coming to you. And if the IUL cash value was so strong and so high potential and so guaranteed and so downside protected, then these banks would be willing to do it with them, would be willing to offer a cash value line of credit with an IUL. They're not willing to. I haven't found one that's willing to, period. I don't know if there's one out there. If you find one that is, let me know. I'm happy to stick my foot in my mouth. But I can tell you I've looked at dozens of these banks and they haven't, not one of them has been willing to do it. So that's something to take into consideration because of the fact that they're highly volatile products at the end of the day, and there's too many moving parts with too many variables that you don't control and that the bank can't control. And the bank is leveraging your cash value as collateral. And if that cash value has a chance to go away by any means other than you spending it irresponsibly, because when you do this line of credit, you can't just go get a loan against your cash value from the insurance company too. They kind of have a lien on that. The right of access to that capital goes from through the life insurance contract and the life insurance company to the line of credit. That's how that works. So you can't do that. So the reason they don't do it through IUL is because, yeah, they could take the right for you to not tap into that capital and it goes to the line of credit, but they can't eliminate the risk of that cash going down and that cash getting destroyed by increasing fees and just variables that I've talked plenty about inside of IULs that ultimately, are out of their control. So that's just more risk than they want to. My guess is they may do it eventually. It's just going to be a higher interest rate to do so, because anytime there's more risk for a bank, they're going to charge a higher interest rate, and that's just the way the game is played. So, yeah, I mean, this is, you know what? This concept, this topic, it's really simple. I don't really have much else to say. I would just say it's something to consider for you. If you have cash value, you got to have about $65,000 or more in cash value. So if you want to dump in a bunch of money and you can commit to a premium of say $15,000, $16,000 a year, I would say if you could do about a $50,000 dump in front loaded, if you had money sitting in a savings account, money sitting in a CD earning nothing, something like that, and you could still commit to a $15,000 forced savings plan inside of a whole life policy, this can be a great solution for you, because you could do the 50 plus 15, probably have to do a little more than that because there is some expenses, but if you structure and design it properly, the first year you could probably put 75 in and meet that liquid need of 65,000 in cash value. And if you do that, you'll qualify with most of these banks, not all of them, because some of them have higher requirements, but a lot of them that I've seen start at about the $65,000 range. So if you could do that, just open a line of credit. You have it there when you need it. It will be liquid, it will be accessible, and it will be at a better interest rate. So it could be great leverage. If you have any questions at all, if you find anything, if you have any comments, whatever, go ahead and comment below. Happy to engage with you on any level. And that's it. So once again, I apologize for my snafu with the audio on the first take of this, but I'm gonna keep this short. I'm gonna keep it sweet, hopefully. I'm back from Costa Rica. I'm gonna be back to doing content on a more regular basis again. The vacation was much needed. It was extremely enjoyed. Super grateful for the opportunity to go down there and meet some new people and build some great relationships and all amazing stuff. So guys, I hope this finds you well. Have a blessed, inspirational day, and I look forward to talking to you tomorrow. Take care.